What's up, guys? Today we are going to cover Unit 4, Financial Sectors, Topic 4.1, which is Financial Assets. Okay, so first we're going to start off with a little bit of vocabulary, and then we'll move into some deeper topics after that. So the financial sector. So individuals, businesses, governments, they all borrow, right? And so they need help or they need institutions to borrow from, right? And so the financial sector is going to be a network of institutions that link borrowers and lenders. This is going to include banks, so like your Wells Fargo's, your Chase, all of those, mutual funds, pension funds, and other financial intermediaries. And then we have assets. So assets are anything that's tangible or intangible that has value. So your assets, right, could be like your PlayStation, your Xbox, your car that you may own, anything in your house that's yours. Your parents' assets could be their home or anything that's TVs and anything that they've bought can be considered your assets, right? More so in the financial sector, assets are going to be like your mutual funds or any your stocks, the bonds that you've purchased or that you hold. Those are all assets, right? So interest rates are the amount a lender charges a borrower for borrowing money. This is the price of a loan. Now, think about that. That's what you pay to take out the loan, right, is going to be your interest rate. And then interest-bearing assets are assets that earned interest over time. So an example of this would be like a bond, right? You buy the bond for $100, and then every year it has some interest rate that's attached to it, and you'll get interest attached, or you'll get interest added to that bond. And then after the course of the life of the bond, or when the bond it has lived its life, then you can exchange that bond for the full amount of the interest rate, right? All right, so just a reminder here that in personal finance, right, in personal finance, you're going to do personal finance stuff. You're going to come up with a budget. You're going to look at, savings and which credit cards are better for you and the stock market and retirement plans and how to take out loans and how to manage your money. This is, this is not a personal finance class. This is an economics class. So, we use words a little bit differently, right? In personal finance, investment means all of those things we talked about, right? In economics, when we talk about investment, we're talking about businesses spending on machinery and tools to make their business better, right? Or able to produce their products better and more efficiently, right? So that makes sense that when we talk about interest rates and investment, right? If you have a low interest rate, investments will go up, right? Why? Because it's cheaper to take out the loan, right? So businesses will see that and they will take out loans when interest rates are less, right? When they're high, right? Businesses might be a little hesitant to take out loans at that point. So they may wait until interest rates lower or see what happens in the future, right? So now, liquidity. The liquidity is when it's the ease of taking money or taking an asset and converting it into a medium of exchange or to converting it into money. So liquefying your money, right? Now, there's some things that are very, very liquid and some things that take a little bit of time to liquefy, right? So in general, the higher the liquidity, the lower rate of return. And so you can see it's going to take time to liquidate your assets, right? Take real estate, for example. You have to sell your home. That home's going to take some time, right? So there's the time aspect with liquidity, and then there's also the rate of return, like how much are you getting back for putting into your home, right? So or into other like mutual funds compared to stocks, right? Or putting your money in a savings account compared to buying a bond or buying, interest index funds or something like that. Because putting your money in a savings account, yes, you can grab that immediately, but a bond or maybe a stock or something like that's going to take some time to sell the stock and then get your money. There's a waiting period before you can withdraw money. So with that, we need to establish the difference between saying what a bond is and what a stock is, right? So, EPISD, just a school district in my town, just bought, just put up a bond to redo a lot of its facilities, right, a few years ago. And so what they did is they sold bonds to in the bond market, and people will buy those bonds and with a certain interest rate attached to it, and the school district is going to collect taxes, and they're going to pay out those bonds when people sell, when those bonds mature, right? And so, but what a bond is essentially, like if we were to take out another example of a bond, right, is if you owned a lemonade stand, right, in front of your house, and you need some startup money, right? And so you go to someone in your family and you say, hey, look, I want to start a lemonade stand. Will you buy a bond for my lemonade stand? So they essentially are going to give you a loan. And that loan is going to be represented with, or is going to have some sort of interest rate attached to it. So let's say, a year, your grandparents buy a $100 bond from for your lemonade stand. In a year, you have to pay that $100 back plus when they cash in the bond, plus the interest that's attached to that bond. Now, your grandparents cannot say anything about the lemonade stand. They can't just say, drink some lemonade and be like, oh man, you're not using enough sugar, or, they have, or, hey, look at this particular brand of sugar, maybe you could sell money. That's not, they cannot do that in a bond, right? They have no ownership of the company, right? Now stocks, right? Let's say that your lemonade stand's doing really well, right? And so you want to go out and you want to sell part of your company, right? So, generally businesses will sell, 49% of their business, and now people can buy part of the business, right? They can buy stocks, right? And then this is going to represent ownership of a corporation, and a stockholder is often entitled to a portion of the profits paid out as dividends. So, if you're selling lemonade, right, and you have stocks, right? So for every $100 you own 51% of the company, you get $51, while the stockholders, right, they get $49, and that's divided amongst the stockholders, right? All the 49 stocks that are out there for your lemonade stand, right? And every year, that's they get a portion, or every day, or however it's broken down, they get a portion of the profits, right? All right, so bond prices and interest rates. So a bond is issued at a specific interest rate and then doesn't change throughout the course of the life of the bond, throughout the life of the bond. So, a lot of you guys, when you guys were younger, maybe your parents bought you, or, some of your family members may have bought you savings bonds, right? And so you keep those savings bonds. It's like a 10-year savings bond, and it's like $100. But that $100 you can take right now, and you can get $100 for it whenever you want. But you want to wait until it matures, right? And when it matures, then you get whatever the interest rate is attached to that savings bond. And then, of course, you cash it in, and and you hope, and that's that there's an interest rate attached to the bond, right? So, so another example, right, would be assume that a 30-year U.S. Treasury bond has a face value of $1,000. That means you can go in and spend, or trade the bond in for $1,000, and the interest rate is 5% for each year. So for 30 years, you will get $50. But you want to wait until the 30th year before you cash it in, right? So that you can get the 50 times the 50 times the 30, right? So each year you get that $50, and then it adds all the way up. So a lot of you guys, when you were younger, may have gotten those savings bonds. Your parents usually give them to you when you graduate from high school, and you take those savings bonds and then you cash them in, and hopefully they've matured, and you're going to get a bunch of money from the interest, right? So now, how does that work in economics? Well, it works like this. So let's say that interest rates fall, right? Interest rates fall. People are going to be interested in buying the bonds from people that have higher interest rates, right? So maybe those people with higher interest rates, they need to sell their bonds, right? Like they need cash. So they'll agree on, they'll agree to sell the bond to somebody else, right? As opposed to that person buying the lower interest rate bond, right? The point of all this is, right, is that, and it's real simple, is that bond prices and interest rates are inversely related. So that means that if bond prices go up, interest rates are going to go down. As interest rates go up, bond prices will go down, okay? And so that's going to be it for 4.1 financial assets. Thank you guys, and have a good one. See you.